A few years ago, I realized that I was paying way more tax than I needed to, but once I learned what I could legally claim, it completely changed how much taxes I was paying every year. So in this video, I'll break down the 12 tax deductions that I'm personally claiming this year to legally save me thousands of dollars in tax. Now, before we get into the actual deductions, let's talk about the 3 golden rules that the ATO uses to decide whether you can actually claim a deduction. Rule number 1 is that you have to have spent the money yourself and weren't reimbursed. Rule number 2 is the expense directly rates to earning your income. And lastly, you have to have a record to prove it, usually in the form of a receipt or a diary. So let's make sure that you're claiming every cent that you're legally entitled to and doing it in a way that keeps the ATO off your back. So the first deduction that I'm claiming is my work from home expenses. And there are 2 methods that we can use for this deduction. The first rule is using the fixed rate method, where we claim 70 cents for every hour you work from home. This covers your electricity, gas, internet, mobile phone, stationery, and computer consumables, all bundled into that one single rate. It makes things super simple, but there is a catch. You can't claim any of those costs separately elsewhere in your return. If you use the 70 cents method and then also claim your mobile phone expenses on top of that, that's called double dipping, which could trigger the ATO to take a closer look at your deductions. Now, in order to use the fixed rate method, you also need a record of your hours, so either a timesheet, a diary, or a spreadsheet will do. Now, what's not covered by the fixed rate method that you can claim separately are work-related assets like laptops, monitors, desks, and office chairs. Also, if they're under $300 and mainly used for work, then you can claim the full amount immediately. If they're over $300, then it has to get depreciated over a few years. The second method to claiming your work from home expenses is using the actual cost method. This is where you calculate the exact work-related percentage of every expense that you've incurred. It does involve a lot more record keeping, but if you've got a lot of legitimate expenses, it can definitely outperform the fixed rate method. So ideally, you'd actually run both calculations and then go with whichever one puts more money back in your pocket. Now, the second tip isn't necessarily a tax deduction, but it is something that you can do that will save you from having to pay thousands of dollars in taxes. And that's by avoiding the Medicare levy surcharge. So here's how it works. Every Australian already pays a 2% Medicare levy based on your income. But if you earn over $101,000 as a single or $202,000 as a family and you don't have private hospital cover, the ATO actually hits you with an additional surcharge on top of that between 1 to 1.5% depending on your income. That's at least $1,000 in extra tax just for not having the right hospital cover. But you can actually avoid that by taking out an eligible private hospital policy, which means that you avoid paying the surcharge. Now, don't just rush out and grab the first policy that you see. You still need to do the comparison first and run the numbers to check if it makes sense in your scenario. Let's say you're earning $105,000. Without private cover, you'd be paying an additional 1% in taxes for the Medicare levy surcharge. So that's $1,050 that goes straight to the ATO's pocket. Now, the price of a basic hospital cover currently sits around $1,200 a year. So in this scenario, it's actually a little bit more expensive to take out the private hospital cover. But the higher your income, the more it makes sense. If you're earning $140,000 per year, that's $1,400 in taxes that you'd have to pay for the surcharge. So by taking out private hospital cover, you'd be saving yourself at least $150 in taxes. Also, be aware that if you're over the age of 30 and you don't take out private hospital cover, you'll be hit with what's known as lifetime health cover loading, where you essentially pay an extra 2% in premiums for every year you are aged over 30. For example, if you waited until age 40 to take out private hospital cover, your premiums will have a 20% premium compared to if you had taken it out earlier. So I've teamed up with Finder for today's video to bring you some great deals on private health insurance. Finder is an independent comparison platform that helps you win at money. They do the heavy lifting to find you the best deals. And right now, through Finder Rewards, you can get a digital Visa card when you switch to select private health covers. It's a win-win. If you're someone who's just looking to avoid the Medicare levy surcharge, they have a reward with HBF where Finder gives you a $200 digital Visa card. And that's on top of the 6 weeks free cover from HBF when you switch to an eligible hospital-only policy. So if you're someone who's earning around $101,000 and sitting on the fence about taking out private hospital cover, that $200 Visa card plus up to 6 weeks of free cover makes the maths a no-brainer. Now, if you're someone who wants more comprehensive cover with extras like dental, physio, and optical on top of the tax benefits, which is what I personally have, then you can get a bigger HBF reward through Finder. They're offering a $500 digital Visa card on top of 14 weeks of free cover from HBF when you switch to an eligible hospital and extras policy. Personally, with a $500 gift card, I'm using that to pay for all of my groceries and fuel. With how expensive everything has been getting, it will definitely help. To claim either of these Finder rewards, click the link in the description or scan the QR code on the screen. Finder will then walk you through the rest. It's super easy, takes about 10 minutes and could save you a whole heap of money. Eligibility criteria apply on both offers. The third tax deduction that you can make is salary sacrificing into your superannuation. And this is one of the most underrated tax strategies available to everyday Aussies. So here's how it works. Instead of your salary hitting your bank account and then getting taxed at your marginal tax rate, you ask your employer to direct a portion of your salary straight into your super before tax is taken out. Those contributions that go towards your super are only taxed at 15% as opposed to your marginal tax rate, which could be as high as 47%. So say you're earning $140,000 a year and you decide to salary sacrifice $10,000. If you took that money as income, you'd pay 37% in taxes, so $3,700. But by salary sacrificing, that same $10,000 is now only taxed at 15% or $1,500, resulting in an instant tax savings of $2,200. And on top of that, that money is now sitting inside super, being invested and compounding in a tax-friendly environment. So you're saving on tax today and building wealth for the future. I personally have a salary sacrificing arrangement set up with my employer each year such that I always hit the maximum cap. Now, if you haven't set up this arrangement with your employer or if you're self-employed, then don't stress. That's where the fourth deduction comes in, and that's by making a personal deductible contribution. This is where you contribute your own after-tax money directly into your super fund, and because the money that you're using has already been taxed, you can then claim a tax deduction when you lodge your tax return. And to do that, you must submit a form called a notice of intent to your super fund before the end of the financial year. You can get this form directly from the ATO, or depending on which super fund, you can actually just log into their portal and then just submit a form. Now be aware that when making a personal deductible contribution, the money has to land into your super account before the end of the financial year, and it can take a few business days since it is done via BPay. So I always recommend doing it a few weeks before the end of the financial year, just to be safe. You'll also need to submit your notice of intent before completing your tax return, otherwise you can't claim the tax deduction. The final super related tax deduction is known as the spouse super contribution. This is when one partner adds money to their spouse's superannuation. This can not only help boost the receiving spouse's retirement savings, but also may provide a tax saving to the partner who contributed the money. This is how it works. If your spouse earns less than $40,000 per year, then you can contribute up to $3,000 to your spouse's super and claim a 18% tax offset, which means you get up to $540 off your tax bill, which is the maximum that you can claim under this scheme. Any contributions that you make to your spouse's super are also treated as non-concessional contributions, which means that they won't impact how much you can personally contribute in concessional contributions that year. The sixth deduction is claiming your car expenses. If you use your personal car for work-related travel, then you can claim those expenses as a deduction. Now, the key thing to note here is that your daily commute to and from work unfortunately doesn't count. That's considered private travel, but if you're driving to a client site, between two workplaces, or to pick up supplies, then those do count. Similar to the work from home deductions, there's two methods to choose from. The first method is the cents per kilometer method, and this year that rate is 88 cents per kilometer, and it covers all of your vehicle's running costs, from the fuel, registration, insurance, depreciation, and also maintenance as well. You can claim a maximum of 5,000 work-related kilometers per car, which means the most that you can claim under this method is $4,400 in deductions. This is definitely the easier of the two methods, since you don't need to keep any receipts for fuel or repairs, but you do need to show how you calculated your work kilometers. So a simple log in your phone, spreadsheet, or diary should suffice. The second method is known as the logbook method. This is where you keep a detailed record of all of your work-related trips over a continuous 12-week period. This is used to establish your business use, and the logbook actually remains valid for 5 years provided your usage pattern stays consistent. You will need to hold on to all of your receipts for all of your car expenses like fuel, insurance, rego, the lot. This one obviously does require a lot more work, but if you're consistently traveling more than 5,000 kilometers per year in your car, then obviously this one makes much more sense. The 7th deduction is claiming any work-related travel expenses. If you're required to travel overnight for work, so think interstate trips, client visits, or work seminars, you can claim those expenses like accommodation, meals, transport, and also incidentals. Now, most of my travel that I do for work as a consultant always does get reimbursed by my clients, and if that's you too, then you can't claim it. Remember the golden rule from the ATO. You have to have spent the money yourself and not have been reimbursed. But there were a handful of trips this year that I made with my own money to attend seminars and workshops which weren't actually reimbursed by my clients. So for those, I am definitely claiming those deductions to make sure that I get everything back. And if that was you too, then make sure you don't leave anything on the table and claim those deductions. The 8th method is optimizing your capital gains tax strategy. Now, you've probably heard of all of the proposed changes to the CGT discount announced by Labor a few weeks ago. We won't touch on that since nothing has been confirmed yet, but regardless of those changes, there are other strategies that you can use to effectively minimize the capital gains tax you need to pay. The first one is known as tax loss harvesting. This is what I'm doing this year. So I've sold some of my positions that are sitting at a loss to lock in those losses. Now, you might be wondering why. Whilst you can't use those losses to offset your income, you can use those capital losses to offset any future capital gains you've made, effectively reducing your future tax bill. But just be aware that you can't sell shares at a loss and then immediately buy back the same shares again. It's a great idea in theory, except this is known as a wash sale and is illegal according to the ATO. You can't sell shares to lock in a loss and then immediately buy them back in a short period of time, especially with the purpose of getting a tax benefit. The second method to optimize your capital gains tax is by changing your sale allocation method. When you sell shares, you actually get to choose which parcels of shares you're selling, and that choice can significantly change your tax position. The 3 methods the ATO recognizes are first in, first out, which sells your oldest shares first, last in, first out, which sells your most recently purchased shares first, and lastly, highest in, first out, which sells the shares with the highest cost base, effectively minimizing your capital gains tax payable. The 9th deduction is any cost related to managing your tax affairs. So that means if you paid a tax accountant or tax agent to prepare your return this year, then that fee is actually claimable. Also, if you use any software or tools to help you manage your taxes like ShareSite to track your investments and generate capital gains tax reports, then that is also tax deductible as well. The 10th method is one that a lot of people either don't know about or forget to claim, and that's income protection insurance. If you're paying premiums for an income protection policy that covers you against the loss of your employment income, then those premiums are actually fully tax deductible. But just be aware that if your income protection policy is held inside your superannuation fund, which is actually pretty common, then those premiums are unfortunately not tax deductible. The deduction only applies if you're paying for the policy directly out of your own pocket outside of super. The 11th method is self-education expenses. If you're studying or undertaking a course that directly relates to your current job, then you can actually claim those expenses as a deduction. But there are 2 criteria that it needs to meet. The course must either maintain or improve the skills and knowledge you need in your current role, or it needs to be likely to result in you increasing your income. And also, a quick tip is that you don't even need to pass the course to claim the deduction. As long as the expense was incurred, it's claimable. Just remember that the golden rules still apply, so keep your records and keep your receipts and make sure the course has a genuine connection to your current employment. The last method is for anyone who owns a business, and that's leveraging the instant asset write-off. Businesses with an annual turnover of less than $10 million can immediately deduct the full cost of assets costing less than $20,000. So instead of depreciating that asset over several years and getting a small deduction each year, you can claim the whole thing right now. And the $20,000 threshold applies per asset. So if you buy a laptop for $1,800, a new desk for $600, and then a new equipment for $8,000, you can write off all three immediately. Also, the government just announced in this year's budget that the $20,000 instant asset write-off will be made permanent from the 1st of July 2026. So it's here to stay, which is great news for small business owners. So those are the 12 tax deductions that I'm making this year. Now look, I'm not a tax accountant, so please consult a professional, but hopefully this video has given you a solid starting point to make sure you're not leaving any money on the table. If you found this video useful, then make sure to hit the like button and drop a comment with the word refund if you've watched all the way to the end, as it lets me know that you got value from this video. And if you want to go deeper into how you can use your superannuation to legally reduce your taxes, then check out this video right here.